Welcome to the Deep Dive, the show engineered to give you, our discerning investor listener, a shortcut to being truly well-informed.
That's the goal.
Today, we're cutting through the noise and diving deep into a company at, well, the fascinating, sometimes turbulent intersection of tech and healthcare. Oscar Health Inc., ticker OSCR.
That's right. And our mission for this deep dive is a multi-layered investor analysis of Oscar Health, specifically as of today, July 30, 2025.
Okay.
We've pulled key insights from comprehensive reports to help you understand Oscar's recent performance, the underlying trends shaping its future, and maybe most importantly, what it all means for your potential investment decisions.
Okay, let's unpack this then. For those who might be new to the name or maybe just following the headlines, who exactly is Oscar Health? What's their unique pitch in this huge healthcare landscape? They get called an insurtech innovator, but what does that actually mean in practice?
Good question. So Oscar Health, they started back in 2012, based in New York City. Fundamentally, they position themselves as a healthcare technology company.
Okay, tech first.
Right. Their core mission is, well, it's ambitious. They aim to use technology and data to simplify how you access and manage healthcare, whether you're an individual or a small business. Trying to make it less confusing, more user-friendly.
So definitely not just another traditional insurance company then. Sounds like they're trying to inject maybe a needed dose of tech thinking into a sector that can be pretty complex.
That's the idea.
How do they operate on the ground, though? What are the business models?
Precisely. They operate through a few distinct models. First, and this is their main thing, they are a technology-centric insurer.
Right.
And that's not just marketing speak. It means they actively use things like mobile apps, pretty sophisticated data analytics, integrated telehealth, all aimed not just at improving the user experience, but critically at managing medical costs more efficiently.
A cost part is key, I imagine.
Absolutely. Second, they have a strong ACA marketplace focus. They primarily target the Affordable Care Act individual and small group market. Now, it's important for you to note, this segment relies heavily on government subsidies.
Which means sensitivity to policy changes, yeah.
Exactly. Policy shifts can really impact them.
And I think I remember hearing about another angle, something with their platform.
You got it. Their third strategic pillar is the Plus Oscar platform. This is interesting. It's where they actually license their own tech solutions, the tools they built for their insurance business, to other insurers and healthcare systems.
Ah, so selling the tech itself.
Right. And the insight here for you, the investor, is that this isn't just about diversification. It's their bet on becoming a major software as a service, or SaaS, provider within healthcare.
Okay, so potentially a different kind of company long term.
Potentially.
Mm-hmm.
If it works, it could seriously de-risk their core insurance business over time. It could shift them from just insurtech to a broader health tech player, which is, quite different investment profile.
That's fascinating. Sort of like selling shovels during the gold rush, maybe? But what gives them an edge, especially when you see the big traditional players, the behemoths, also pouring money into digital now?
Yeah, that's the critical question. Their core competitive strengths, they claim, lie squarely in that technological innovation. We're talking about robust data and AI capabilities.
Okay.
They argue this allows for more personalized services and, crucially, better cost prediction. The aim is to translate that into a superior user experience. Think intuitive apps, integrated care teams, which, let's face it, can be a stark contrast to traditional insurance interactions.
Definitely can be frustrating, yeah.
And finally, there's the growth potential. They're tackling a massive, often inefficient existing market. But the real insight for investors, I think, is whether their tech truly provides a sustainable advantage in managing costs, not just making the app look nice.
Right, the cost management piece. That seems like the recurring theme.
It is.
So they're innovative, they've got these different business models. But how does this actually translate financially? We've seen some recent headlines that, well, paint a rather volatile picture, haven't we? It's been quite a ride for the stock.
It certainly has. And it's really important to remember, Oscar is still fundamentally a growth stage company.
Right.
Historically, they've prioritized growing subscribers and revenue over immediate profit. That's pretty common for tech disruptors. But yes, recent events really highlight a significant shift and some dramatic swings.
Tell us about those swings. I remember some good news not too long ago that surprised folks.
Yes, absolutely. The positive Q1 2025 story that was announced back on May 8th, it was a huge milestone.
What happened?
Oscar reported a surprising net income actual profit of $275 million, or 0.922 per share. This was their first ever profitable quarter since going public, a really big deal after years of losses.
Wow, okay, first profit.
And they also showed an improved medical loss ratio, the MLR. Just to remind everyone, the MLR is critical for insurers. It's the ratio of what they spend on medical care versus the premiums they collect. A lower MLR is better, means more profitable.
So Q1 looked great. First profit, better MLR. That was the high point then. What happened next to cause this reversal?
Well, then came the challenging Q2 2025 preliminary results. These were announced just recently, July 22nd.
Okay.
And Oscar announced an expected operating loss of around $230 million for Q2.
Oof. From $275 million profit to a $230 million loss quarter over quarter. What drove that?
The primary reason they cited was a higher than anticipated MLR, specifically higher healthcare utilization rates, particularly in that individual ACA market we talked about.
So people used more healthcare than they expected.
Essentially, yes. And what's more, management also mentioned they might need to refile their 2026 rates.
Refile rates, what does that signal?
It signals they need to adjust pricing upwards for the future because the current pool of members is proving riskier, meaning more costly, than anticipated. They're basically telling regulators, hey, our costs are higher than planned, that we need to charge more next year to cover it.
Okay, so trying to get ahead of future losses, maybe.
Potentially, yes. And this hints that their full year 2025 guidance might need adjusting too. That guidance currently projects $11.2 to $11.3 billion in revenue and $225 to $275 million in non-GAAP operating income.
And just quickly, non-GAAP operating income is?
It's a measure of core profitability. It strips out certain one-time or non-cash items like stock-based compensation or acquisition costs to give you, the investor, a clearer view of the underlying business performance.
Got it. So they hit this amazing profit milestone, then just weeks later, pivot to a big expected loss, mostly pinned on this MLR. It's fascinating, this huge swing tied to MLR. What does this tell us about the core challenge for Oscar and maybe for InsurTech generally?
I think it reveals that Oscar's at a really crucial turning point. Proving sustained profitability and effective MLR management is now absolutely paramount. That Q2 warning basically puts their entire profitability story from Q1 under some serious scrutiny. It underscores a fundamental truth. While technology can enhance the experience and maybe find some efficiencies, predicting and managing healthcare costs, that remains the make-or-break factor for any insurance company, whether they're tech-driven or not. This is where the insurer part of InsurTech really bites back at the tech aspirations.
That makes a lot of sense. Okay, so here's where it gets, I think, really interesting. Beyond Oscar's own internal stuff, what are the broader trends, in the health insurance sector, the overall economy, what's impacting them from the outside? It's never just about one company in isolation.
You're absolutely right. It's a complex ecosystem. First, let's look at InsurTech trends and challenges. The whole industry is moving towards digital transformation, using data for underwriting personalized services. Oscar is definitely a leader there. But many InsurTechs have really struggled with consistent profitability. Take Bright Health Group, for instance. Their well-publicized difficulties really illustrate how tough it is to manage medical costs and navigate the regulatory maze, even if you have fancy tech. So the insight for you is that the promise of tech efficiency often bumps up hard against the unpredictable reality of human health needs and costs.
So great tech isn't enough. You still have to nail the fundamental insurance business model within the existing system.
Exactly. Then you've got the ACA marketplace dynamics. We mentioned its heavy reliance on government subsidies. That's a big factor influencing membership and how affordable plans are.
Right.
It's also susceptible to what's called risk pool volatility.
Right.
Basically, if the group of people they insure suddenly gets sicker or uses way more services than predicted.
Like Oscar saw in Q2.
Precisely. That directly hits the insurer's bottom line. And those annual rate filings we mentioned, where they propose prices for next year, higher utilization directly feeds into needing higher rates in the future.
It sounds like they're constantly trying to hit a moving target with those costs.
It really is.
What about broader healthcare trends? Are people just using more healthcare services now across the board?
Generally, yes. We've seen a noticeable increase in healthcare utilization trends post-pandemic. People are catching up on elective procedures they put off. There's increased demand for mental health services, just generally engaging more with the system.
And that pressures MLRs for everyone, not just Oscar.
Correct. It's a sector-wide challenge, putting upward pressure on costs for pretty much all health insurers.
Okay, and then stepping back even further, the big economic forces. Inflation Interest rates. How do those play into this for an insurer like Oscar?
Oh, absolutely. Macroeconomic influences are significant. Inflation is a big one. Specifically, healthcare inflation, think rising drug prices, higher wages for nurses and doctors due to labor shortages.
Yeah.
That directly inflates medical expenses, which pushes up the MLR. And unfortunately, the outlook for U.S. inflation in 2025 suggests it's likely to stay above target. So continued cost pressure.
And interest rates. The Fed seems to be holding steady for now.
Right. The U.S. Federal Reserve is likely holding rates steady until at least maybe March 2026.
Yeah.
Now, higher rates generally depress valuations for growth stocks like Oscar because future potential earnings are discounted more heavily.
Okay.
And for companies like Oscar that aren't yet consistently profitable, higher rates also mean it costs more if they need to raise capital in the future.
All right. So given all these pressures, internal MLR issues, sector trends, macro factors, what are the specific risks that you, as an investor, should really be focusing on when looking at Oscar Health? Sounds like quite a few layers.
There are, and understanding them is crucial. Number one, without a doubt, is MLR management volatility.
Back to the MLR again.
Always back to the MLR. As we saw with Q2, the sheer unpredictability of medical costs can just blow up profitability forecasts. If they can't get a consistent handle on this, it doesn't matter how good their tech is, they'll struggle with ongoing losses.
It's about predicting human health needs and costs for a huge group of people. That just feels like a fundamentally tough challenge, even with AI.
It truly is. A second major risk is the regulatory environment and ACA dependence. Their business is so deeply tied to the ACA market. Any changes in government policy subsidies, regulations could directly hit their membership and revenue.
And that potential rate refiling highlights that sensitivity.
Exactly. Then there's intense competition. Oscar isn't playing in an empty field. They're up against huge established players like United Health, Elevance Health.
The giants.
Yeah, the giants. They have vast resources, huge networks, and crucially, they're also investing heavily in their own digital transformation. So Oscar's tech edge might erode over time, or at least become harder to maintain as a key differentiator.
It's like a speedboat versus supertankers, and the supertankers are upgrading their engines too.
That's a good analogy. What about the Plus Oscar platform? That tech licensing piece seemed promising, but is there a risk there too? There is. It's promising, for sure, as a diversification play into potentially higher margins.
Yeah.
But the Plus Oscar platform uncertainty is real. We don't yet know the true market demand or their ability to sign enough deals with other insurers.
So, potential, but unproven at scale.
Correct. Its growth is important for their long-term story, providing high-margin revenue, but it's not a guaranteed success yet, and it faces its own competitive landscape too. Finally, you can't ignore data privacy and security.
Always critical with health data.
Absolutely. Handling sensitive personal health info means huge risks. Data breaches, cyber attacks, these could lead to massive fines, lawsuits, and, perhaps worst of all, a complete loss of customer trust.
Okay, so putting it all together, what does this mean for your investment strategy? Is Oscar, with all its innovation, volatility, risks, is it a buy, sell, hold? And what should you, the investor, really zero in on if you're considering this company?
Look, Oscar Health, right now, today,
Yeah.
it absolutely has to be characterized as a speculative, high-risk, high-reward investment.
Definitely not for the faint of heart or short-term players.
No, definitely not, especially given the recent volatility. For anyone considering it, the absolute most critical metrics to watch are the medical loss ratio, MLR, and their ability to demonstrate sustained profitability, not just one good quarter.
Right. Consistency is key.
Exactly. You need to see concrete plans and, more importantly, consistent results showing they can stabilize that MLR over multiple quarters. Proof that their tech can genuinely manage costs effectively.
So looking beyond the immediate headlines and noise, what are the specific signposts or catalysts investors should watch for? How can they gauge progress?
Okay, key catalysts to watch. First, the full Q2 earnings report release and any official updates to their guidance for the rest of 2025 and maybe even into 2026. That will give you a much clearer picture of management's own expectations and their strategy to tackle these Q2 challenges.
See what their plan is.
Precisely. Also, keep a very close eye on the growth and financial contribution of the Plus Oscar platform. If that segment starts showing real traction, signing significant deals, contributing high-margin revenue, that could be a powerful driver for future valuation.
Makes sense. What about valuation itself? Does it look cheap or expensive right now?
Well, valuation metrics are interesting here. Their current price-to-sales PS ratio is around 0.42. That's quite low compared to the industry average, suggesting the market isn't valuing their revenue stream as highly as peers right now.
Okay.
Their 2024 price-to-earnings PE ratio, based on that brief profitability, was about 29.66. Now, that could suggest value if, and it's a big if, they could achieve sustained high growth and consistent profitability.
And cash. Do they have enough runway?
That's another important point. They do have substantial cash reserves, about $2.23 billion as of the end of Q1 2025. That's over 40% of their current market cap, which is the total value of their stock.
So, decent buffer.
It provides a buffer, yes.
Yeah.
But you have to remember, continued operating losses like the one expected in Q2 will accelerate how quickly they burn through that cash. So
Yeah.
monitoring that cash runway is also crucial.
Right. Okay, we've covered a lot. The tech, the financials, the market, the risks. Given everything, what stands out to you as the single most important takeaway for our listener from this deep dive into Oscar Health?
I think the single most important takeaway is this. Oscar Health has a genuinely ambitious vision. They want to use tech to revolutionize healthcare, and they have shown flashes of brilliance, like that Q1 profit. But the recent Q2 warning really hammers home the fundamental ongoing challenge, managing the unpredictable costs of healthcare. It's the core insurance problem. And even the best technology has to constantly battle and ultimately master that challenge to deliver consistent profitability.
So the ultimate question for you, the investor, really boils down to this. Can Oscar truly leverage its innovative technology to finally tame the unpredictable beast of healthcare costs and become a sustainably profitable company? Or will the insurer part of InsurTech always prove too powerful, too challenging for the tech side of this company? That's the billion-dollar question you need to answer for yourself. If this deep dive was helpful in informing your investment strategy, please consider subscribing or sharing with a fellow investor.